Welcome everyone to my update for the March 2021 quarter. As usual, I'll start with some interesting news, work through portfolio and asset class returns, and then I'm going to touch on diversification. I was never going to be able to start talking about this quarter without referencing COVID-19. Last time we talked about vaccines being developed. Now I can talk about vaccines being rolled out. As at 31 March 2021, 331 million people around the world had received at least one dose of the vaccine. That's around 4.4% of the world's population. 128 million people, approximately, had received their full vaccination. That's around 1.7% of the total world population. That's continued to increase as at the end of 14 April, when I was preparing these notes, that had increased to around about 6.7% of the world's population having received at least one dose. In New Zealand, we're a little bit slower. As at the end of March, around 16,500 people were fully vaccinated. About 51,000 people had received at least one jab. That's about 0.4% of our population. That has risen to around about 71,000 people who had received the jab as at 6th of April, and 19,000 who had been fully vaccinated. Still a bit of work to do. We had an announcement about an announcement of a travel bubble during the quarter, and on the 19th of April, just in time for school holidays, we'll have a trans-Tasman bubble. And interest rates in New Zealand and around the rest of the world have increased. That's interesting because usually interest rates increase when the market expects there's going to be either inflation or an economic recovery or both. Broadly, we could say that's good news. However, the Reserve Bank of New Zealand isn't sure it agrees. While I was preparing this slideshow, the Reserve Bank met and held interest rates. They mentioned that there were still significant risks to the global economy and its recovery, and that they intended to hold rates and could cut them further. This slide shows the growth of $1 for the 3 months ended 31 March 2021. Up top is international shares unhedged, which would have grown to around about $1.08. In second place, in Canary Yellow or Australian Gold, depending on which commentator you listen to, Australian shares would have grown to $1.06. The worst performer over this 3 months was New Zealand property. $1 invested in New Zealand property listed on the stock exchange would have fallen from $1 to around about 96 cents. In fact, every New Zealand asset class except cash would have delivered a negative return for this quarter. A 50-50 mix of shares and property and cash and fixed interest would have grown to around about $1.02. That's interesting. A solid quarter where diversification mattered. But what about the year? 1 full year on from the COVID crash and every line is up. The leader this time is Australian shares. $1 invested 12 months ago would have grown to around about $1.45. In second place is emerging market shares, where $1 would have turned into around about $1.36. A creditable fifth is a 50-50 mix of shares and property and cash and fixed interest. $1 invested 12 months ago, before any tax, would have grown to around about $1.22. That's a really good result. Well and truly back to where we were, in fact ahead in some cases of a full year ago. That seemed a long way away this time last year when I was recording this update. How about over 3 years? This time, the leader of the pack, with $1 having grown into $1.55, is New Zealand shares. In second place is New Zealand property, having grown to approximately $1.50. Again, a creditable middle of the pack outcome, a 50-50 mix of shares and property and cash and fixed interest would have grown to around about $1.25. This is, broadly speaking, around about the long run expected return for this mix of assets. That's despite the tumult we've had in the last 15 months, in fact 3 years. I want to talk now about diversification. Now, for those of you that receive our quarterly updates, this is a resource you might have seen earlier in the year. We tend to send it out in January, early February. This slide, colourful and busy, shows the performance of the various asset classes we sometimes use in client portfolios. The returns go back for calendar years all the way back to 1991. The slide's in two parts. The top part has each individual asset class with its calendar year return next to it all the way out to the end of 2020. The bottom part, and it's the interesting part, ranks these returns from highest to lowest for each individual year. Usually, in client meetings, I tend to pose the somewhat trick question of what's the pattern. It's a trick question because there isn't one. Only twice throughout this whole data set does the top performing asset class in any one year become the top performing asset class in another year. Actually, 5 times the top performing asset class in one year is the bottom performing asset class the next year. The only thing that resembles a pattern in any way is the teal 50-50 mix of shares and property and cash and fixed interest that is middle of the pack all the way through. Now, definitionally, because it's a diversified portfolio, it can never be top, but it can also never be bottom. And that means that it's a more predictable way of earning your expected return than trying to pick the best asset class for next year, because it's pretty hard. What this says is that diversification works. You should use it. Thank you everyone for watching this video. I hope you found it useful and informative. I look forward to updating you again next quarter.